What is an asset? Cash is an asset, although it's probably not considered so most times. Section 42 of the IRS Code, more commonly known as the Low-Income Housing Tax Credit Program, considers that $20 in my wallet as an asset. Checking and savings accounts are assets, and your usual investment accounts of stocks and bonds, treasury bills, mutual funds, and CDs, these are all assets. And what about that life insurance policy? Yes, that's an asset. Anything that can be converted to cash is an asset. Of course, not all of it is counted as assets for the affordable housing programs. Take a look at real estate, for example. Let's say that I recently sold my house for less than fair market value. Unlikely, but it does happen. The fair market value at the time of the sale would be considered an asset on my resident certification for 2 years from the time of the sale. What if I keep that same house and rent it out? It's no longer considered an asset. We now look at it as a source of income. In this webcast, I'll help you to understand the often complex world of assets within the affordable housing arena and make the proper calculations of those assets so that you can avoid the sometimes simple mistake of moving in an overqualified household. Welcome to Calculating Assets 101. So we've talked about the $20 in my wallet, but did you also realize that some people may choose to keep their money at home? Any cash on hand is considered an asset and must be included in the resident certification. The rules for calculating checking and savings accounts are fairly simple. Use the current amount for savings and the last 6 months' average for the checking account. The easiest way and recommended method to obtain any account balance is to use the deposit verification request form that we supply on our website. That's at www.wshfc.org/managers/forms-index. If you absolutely cannot obtain a completed form, you can use bank statements, but remember you must collect the most recent 6-month statements for the checking account balance. Quarterly statements are typically given for stocks, bonds, CDs, and similar investment accounts, as well as pensions. Hopefully your resident keeps these filed for easy access. Lump sum amounts, such as casino or lottery winnings, or an inheritance, must also be counted. It might be tough to believe, but there are some things that the IRS is not the least bit interested in. Some types of assets that they have no interest in knowing about. Personal property, like cars and trucks, jewelry, business assets. These things the IRS could care less about when it comes to qualifying for affordable housing. Of course, if that car is a mint-condition 1934 Ford Coupe that is kept in a climate-controlled environment and recently appraised for $40,000, they are mighty interested in that. But I'm talking about the Ford Focus that gets your residents to and from their daily job, and to the supermarket, and down to the school to pick up the kids from baseball practice. And that wedding ring and other jewelry that is worn every day. The giant plasma TV that the family bought for the Super Bowl. These types of personal property are not viewed as investment, and therefore are not considered by the IRS. Johnny's grandmother gave him a $500 savings bond for his first birthday 8 years ago. Even though Johnny doesn't understand what it is, do we still count it toward the family's assets? Yes. The assets that are counted must include the entire household, even children. But if Johnny is a foster child, do we still count the savings bond? No. Foster children, foster adults, and personal care or live-in attendants are not considered part of the household for the purpose of calculating assets. To go one step further, live-in attendants are typically not even on the lease and must vacate the unit immediately if the resident vacates for whatever reason. In a minute, we'll take a look at a hypothetical certification and how all of these assets are calculated in the real world. Remember that the income from the asset is always counted toward the household's annual income amount for qualification purposes. It's pretty simple for cash on hand. There is no interest being made, so that would be zero. Use the current balance for savings accounts and the average of the last 6 months for checking accounts. The easiest way to find this amount is to use the deposit verification request. Complete the top half with your applicant, have them sign it, Then fax it or mail it to the bank. Bank personnel will complete the bottom portion of the form and send it back. The rules for real estate are fairly simple. Determine the current market value, then deduct 10% for selling costs, and subtract any remaining mortgage. Fairly simple, right? Personal property that is considered an investment is very similar. Determine the current value by a recent appraisal, deduct 10%, and there you go. So let's look at an example of determining what the income would be if someone were to rent his or her house. To determine this information, you will need to obtain copies of a recent bank statement, a rental agreement, and the current lease covering the next 12 months. The bank statement indicates that the monthly mortgage payment is $1,000. The rental agreement and lease indicate the house is currently renting for $1,200. The income from this house is $200 per month, or $2,400 annually. Remember to remind your applicants that income is determined using the anticipated amount for the next 12 months, and any change in the mortgage or rental amount over the next 12 months must be disclosed. Before we look at a certification and the assets you might find in a real-life situation, let's go over some definitions of different types of investment accounts. First, let's look at basic retirement accounts. The IRA, or Individual Retirement Account, is one which allows us to deposit pre-tax dollars into an account as we work. The taxes are paid when we retire and begin withdrawals. Most of these allow early withdrawal, but that is often prevented with a large percentage going to taxes. Next is the Roth IRA. This is a modified IRA where a person can set aside after-tax income to a specified amount each year. This continues to grow tax-free, and withdrawals can be made at age 59 and a half. Both IRAs and Roth IRAs work the same, but are different as far as tax deductibility. IRAs are typically used by individuals who do not have a retirement plan through their employer. The 401k is named after the section of the IRS code that authorizes them. 401k is the plan most commonly known. A worker deposits a portion of their gross earnings into the account to avoid income tax on that portion of the earnings. The earnings are subject to taxation when the retiring worker receives them. Plans are employer-based, and many employers match contributions. Most plans have a vesting schedule. Mutual funds are a pooling of assets by thousands of investors, set up with a variety of stocks and bonds, and professionally managed. An example would be Fidelity Growth Company. The advantage of this type of investment is that the portfolios are diversified, so there is less chance of losing the entire investment. The gains or losses are shared by all of the shareholders. An annuity is the general reference of a deferred investment contract that, upon annuitization, will make regular payments to a person for a period of time or over one or more persons' lifetimes. These contracts provide income during retirement or can provide a stream of payments as a settlement of a personal injury lawsuit. For the tax credit and bond programs, income is figured two different ways depending on how the individual decides to withdraw the funds. If they choose to withdraw all of the funds, you treat it as an asset. If they choose to withdraw the money in installments, it is treated as income. Fixed annuities make payments in fixed amounts or in amounts that increase by a fixed percentage, while variable annuities pay amounts that vary according to the investment performance of a specified set of investments, typically bond and equity mutual funds. This concludes Part 1 of Calculating Assets 101. Be sure to check out Part 2 and the resident certification examples.